It's Brian Preston, the money guy.
I think for most people, your house, your primary residence, is probably the single largest purchase you'll make in your whole life. It's the most expensive thing that we buy, right? I mean, for most folks, that holds true.
And I feel like there's a general rule out there that, you hear about when you're trying to figure out how much can you afford. We talk about 25% of income, but you also, if you're looking for benchmarks, 3 times your income. Sure. However, I have a feeling, because if you ask a mortgage broker, how much can I afford? Or you ask your real estate agent, they're not going to tell you 3 times your income. I bet that number is going to creep up a good bit further. So, Bo, we have the resources where we can actually do research. What did we find out on what the typical American's doing?
So we know that right now the median household income in this country is a little over $63,000. So you would think, all right, if the median household income is $63,000, I should just multiply that times 3, so the median home price ought to be about $190,000. Well, what we found is that the median home price is actually almost $318,000. So if you just take $318,000 divided by $63,000, the median new home is 5 times the average median income. That means most Americans, instead of buying a house that is 3 times their annual income, they're buying one that is 5 times their annual income.
So I can already hear it. Everybody who's out there listening in New York, California, or just high cost of living areas is going, oh my goodness, I wish I could buy a house for $317,000. Sure. But I will tell you, the point we're making is that probably if you do live in a higher cost of living city, that more of your monthly income is going towards your shelter.
Sure.
And that actually has a large impact on your financial life. And that's why we want to go a little deeper and kind of compare. If we know that the average American is spending 5 times their income, but we feel that 3 times is more appropriate, what is that difference doing to your long-term financial self?
So again, let's kind of just walk through this case study. So we know that at 5 times the median household income, that's a home price of about $318,000. If you were going to do 3 times, we're going to call that the affordable home. That'd be about $190,000. Well, we're going to put 20% down. That's kind of rule of thumb. We want to get out of PMI. So the mortgage that you're going to have on your expensive home is going to be about $254,000. The mortgage that you would have on the affordable home is going to be just under about $152,000. Well, when you run that through, you're looking at a monthly payment of either $1,200 a month for the expensive home or a little over $700 a month for the affordable home. And if you just calculate the difference, that's about $490 a month.
Now, wait a minute. Pause, because we know there's a lot more going on than just $500 a month. Because the bigger your house is, the nicer it is. Property taxes are more. Your insurance on the house is more. Probably it's bigger, so it's going to have more furniture cost. I'm going to go ahead and tell you, they've made it premium comes in. The bigger your house is, when you have people show up to do service, landscaping or other things, if your house is nice, they charge you more to clean the windows, other things. So we didn't put any of that in there. So that's not built into our analysis. We did the bare bones conservative approach to this to keep the numbers reasonable. We just took the difference in the monthly payments only on the principal and interest of the mortgage.
That's exactly right. So if we think about that $490 a month saving, what if instead of buying the more expensive home, you bought the affordable home and you saved that $490 per month? Well, what ends up happening, and again, we assumed a 30-year-old, so we're using a 9% rate of return here. Over that 30-year mortgage period, you will have saved $176,400. But because you are investing that, by the time you get to age 65, it will be worth over $1.4 million.
So you can tell, guys, this is huge. This is a 7-figure decision that a lot of people walk into, because when you build a house or buy a house, it's so easy to focus on the payment and say, well, gosh, I really would like to have this feature. I'd really like to have this. And I can afford it because it's only $150 more a month for this feature. It's only $150 more a month because especially when you're building a house, your builder will tell you, I can do anything for a price.
That's right.
And then when you think about you can amortize it over 30 years, even expensive stuff seems affordable on a monthly basis. But remember, you're not investing in yourself or in your future. you're paying down debt for every additional upgrade that maybe you didn't need, or maybe it was a stretch bigger than what you can afford. All these things have a long-term impact, and $1.5 million is nothing to sneeze at when you're talking about your financial independence.
And so if you're someone out there listening in iTunes World, iHeartRadio, Stitcher, and you're not actually watching this on YouTube, one of the things that we do on YouTube and Facebook is we live stream this. And Brian, you've already alluded to this. We have so many folks in the comments talking about high cost of living areas, and those home prices don't make sense. Here's what I would have you step back and think about. No matter what homes cost in your area, no matter where that is, if you're looking at two different mortgage payments and the difference in those mortgage payments is $500 a month, this mathematics applies. So whether it's looking at a $2,500 mortgage versus a $3,000 mortgage, this math applies when it comes to making your housing decision.
Yep.